We're recording. Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. So, we got to talk about the FOMC. We had Jerome Powell come out, say a couple of things. The markets were rattled, equities were jumping up and down here and there, bond markets as well. And there's a couple of things that are really important that I want to share with you today and talk about important lines that may predict what might be coming down in the future when it comes to the economy, when it comes to monetary policy, interest rates, etc., etc. So hopefully this is informative for you. You get something out of this. I'm going to try to present my screen here. Um, but I'm going to start off with the statement. So, right at 2 o'clock, when Jerome Powell comes out, there's a statement, right? And sorry, not when Jerome Powell comes out. 2 o'clock, there's a statement that comes out, and then 2:30, you get the press conference, and that's when Jerome Powell comes out, right? So 2 o'clock is a statement. This is their update on monetary policies, their views, the committee's views, and so on. So let's take a look at that and see how that plays out. Right. So I'm going to share screen, window. Here we go. Share. Do you see it? There we go. All right. So what you see here is the statement, and it's a statement of today, and it also includes the last statement in December. So what you see in red is basically what's been removed from the statement. So the red was basically in the statement in December, so last month, what they were talking about, and the green is new additions to today's statement. So this is to again, let me recap. This is today's statement, and what you see in red is what's been removed, and what's in green is what's been added to the statement. Okay? So basically, it starts off saying recent indicators suggest growth of economic activity. All right. So, first things first, here in the line, they removed growth of economic activity. So, basically, how it should read now is recent indicators suggest that economic activity. So, the removal of the growth is basically telling you that what? We're not growing anymore? Well, yeah, sure, when you look at certain data points, like for example, ISM and so on, yeah, there is weakness in the economy. But it's funny because during the press conference, Jerome Powell keeps coming out and saying the economy's fine, the economy's fine, the economy's doing well, it's strong, resilient, etc., etc. But then you removed it from the statement, which is confusing. But anyways, let's move on, right? He then goes on and says economic activity has slowed from its strong pace in the third quarter. So recent indicators suggest that economic activity has slowed from its strong pace in the third quarter. This has been removed also. So slowed from its strong pace has been removed, and what's been added is economic activity has been expanding at a solid pace. So they're changing the words from slowed from saying slowed from its strong pace to expanding at a solid pace. Okay, so a little bit of adjustment there at the end of the sentence, which is nothing crazy or big. And then goes on to say job gains have moderated since last year, and added last year instead of um, earlier in day. Okay, so now again, nothing crazy, nothing important in that little removal there. Now, what's really important is this second paragraph here. Goes on to say the US banking system is sound and resilient. All right? US banking system is sound and resilient. Tighter financial conditions and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these remain. This whole line was removed. I think that is the most crucial, most important thing. And I'm surprised no one hounded Jerome Powell on that, on this specific line. Maybe I missed it, but I didn't hear that in the press conference where a reporter hounded Powell talking about why did you remove the US banking system is sound and resilient. So last month, Jerome Powell was telling you that the banking system is sound and resilient. But this month, after a month, he's come out and said the US banking basically removed the US banking system being sound and resilient. Tighter financial conditions, credit conditions for household and business are likely to weigh on economic activity, hiring, and inflation. Completely remove that. Why did he remove the resilience and sound banking system? Is there something to worry about for the banking system? Now, what's also very interesting is that when you look at a stock today, New York Community Bank Corp, the ticker NYCB, that stock dropped. Let me show you. Look at this here. That stock dropped 37%, right? Today. Makes you wonder what's going on. And also you have the Fed coming out saying removing the banking system no longer sound and resilient. So interesting there. We'll see what comes out of that. Could it mean that, Powell is worried? Is he worried about something? I mean, we will see. Oops. Let me share screen again. Entire screen. There we go. Okay. So, U.S. banking system sound and resilient, removed. Now, what was added is committee seeks to achieve maximum employment and inflation at 2% over the long run. The committee judges that risks to achieving its employment and inflation goals are moving into a better balance. The economic activity, the economic outlook is uncertain. So, basically talking about in that line inflation, right? Hounding that, hey, we want to still achieve this inflation target, talking about 2% target. Don't think that we're not moving away from the 2% target. And he added that line there because a lot of people think rate cuts are coming soon, which I'll talk about today also, whether it's coming or not, especially in March. So, also talks about added the committee judges the risk for achieving employment inflation goals are moving into a better balance. Okay, don't really understand what do you mean by better balance. That okay, things are getting better from the peak. Okay, totally understand that, but the goal is still not done, right? Like you said here, still need to achieve the 2% target as mentioned here. Now, in the next paragraph, they remove the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Interesting that they remove this. Are they no longer seeking to achieve maximum employment and inflation at the 2% over the long run? Maybe they could be thinking that we already believe that employment has already, is going to achieve its target or has already been in a good spot, but we're going to focus more on inflation, which may mean that employment is going to get maybe worse off, right? But let me tell you one thing: the dual mandate's always there, so there's no change to the dual mandate. It's just been removed from there. From the statement here doesn't mean that the dual mandate hasn't changed. They do always make sure employment is part of one of their mandates, making sure that it's not weak and doesn't get really worse off. Because in the press conference, Powell did say that if employment does get worse off, they're going to think about cutting rates, right? So it is part of their dual mandate. So don't get confused by that. Then they removed also this line here. The committee will continue to assess additional information and its implications for monetary policy in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy and lags which monetary policy affects economic activity, inflation, economic development, blah, 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 right? So what's important in this line here is that in determining the extent of any additional policy firming, this was removed, basically telling you that they're done with hiking rates. There's no need to be talking about tightening and hiking rates, right? Because if you're worried about the US banking system that's not sound and resilient, you're definitely not tightening further. You're maybe keeping rates where it is and still doing QT, right? Quantitative tightening, and still creating tightening conditions, but now it's all a game of when that first rate cut's going to come, when that the shit's going to hit the fan, right? Then they add these two lines here in this paragraph. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, the balance of risk. The committee does not expect it will be appropriate to, okay, the most important line is right here. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving substantially towards 2%. Okay? Key line. They did this on purpose because everyone thinks that, rate cuts are coming soon. They did this for a reason, to basically tell you that no, rate cuts are not coming in March. Okay? And this was confirmed in the press conference. Powell did explicitly say, rate cuts in March is not their base case. And I'll show you what happened after that. But the fact that they added this to the statement at 2 o'clock basically says that they want to see more data that inflation's coming down, and it's and enough data that they're confident, because as we've seen in the past, the Federal Reserve has messed up many times. They messed up on basically calling inflation transitory. And guess what? Inflation was not transitory. It was not transitory at all. And what happened after a year when inflation jumped, the CPI and inflation numbers in the US, jumped aggressively? They finally came out in December of 2021 and said, hey, we were wrong. Looks like inflation is not transitory. We're going to go on a crazy hiking cycle. They didn't say it like that, but that's what happened afterwards, right? And so they're basically telling you here, they don't want to be too early on cutting rates. They want to have enough information, enough data, which means, again, they're going to be late to cutting rates. They're going to screw up something's going to screw up. When something screws up, and then yes, inflation does come down, and when inflation comes down, then they start cutting rates, right? Already, remember, let's not forget this line here. The US banking system is sound and resilient. It's been removed. What happened to the banking system? For a full year last year, right? Jerome Powell was telling us banking system's fine. Banking system is fine. Why did you remove that? Right? And everyone wants to tell you that rate cuts are good and rate cuts are coming. Well, we'll see. We'll see how much that is true or not. Okay, so these were the biggest things during the statement, and the big two lines is that banking system being removed, the resilience, right? The weakness in the economy, and the most important is that this line: the committee does not expect it will be appropriate to reduce the target range until greater confidence inflation is moving down. So that means they will keep things tight until shit hits the fan, or until employment gets worse off. Okay, so moving on, let's look at what happened to the pricing of the probabilities of rate cuts. So The chances of a rate cut in March has dropped to now 34%. All right, the first rate cut. Before this meeting, it was sitting in the early of this year, was sitting around at 70%. That dropped to 60. Then that dropped to a little bit below 50%. And then when Jerome Powell came out during the press conference at 2:30, said rate cut in March is not their base case, this dropped to 34%. Okay? So March rate cut is out. It's out. It's not in the game anymore. It's not on the playbook. It's out. All right? Make that clear. May. Let's look at the probabilities of May. So there's a 60% chance of a rate cut, at least one rate cut in May. Okay, so you got the markets basically pricing, okay, if not March, you're going to do it in May, right? Right, Powell? Right, Powell? Because the banking system's not resilient. It's not sound. There's something going on, Powell. You're definitely going to be cutting rates soon. We'll see if that changes, just like the March one. Now, here's some notes here from the press conference that's interesting that you might want to know about. These were a couple of the points. So Jerome Powell says 6 months data on inflation is good enough, but we have to have confidence it will continue. Okay. So again, pushing back on rate cuts coming anytime soon. Wants to see 6 months of data, but if it's still showing the stickiness, they're not cutting anytime soon. The economy is not crumbling. Employment's still fine. Guess what? They're not cutting anytime soon. We need to see more evidence that confirms that we think we're seeing. Okay, more evidence, more evidence, more evidence before they cut rates. We want to see more good data, not looking for better data, but more good data. Multiple reports and we're going to go over it in this channel. We're going to go over the inflation data, CPI, all of that good stuffs month by month and see how this plays out. Also said almost every participant on the committee does believe it will be appropriate to lower rates. So they want to lower rates 100%. But they don't want to be early. Remember that. And they're never early. Their history, their track record has always been late. They were late before. Past history of many years back of other central banks, they've always been late to the party. This time is not different, okay? They're going to be late again. They're going to be late. They've already screwed up on their policy. They're going to be late again in terms of cutting rates. Things are going to get worse off. When things get worse off, they're going to be really late in doing something about it, and I feel that's going to create a tantrum in the markets. Moving on, an unexpected drop in unemployment would absolutely argue for cutting sooner. Okay, so there you go. Dual mandate. Inflation needs to get to 2%, and the employment level. If the unemployment rate jumps, right, and jobs are getting worse off, then they're ready to cut. And that's what they want. And if you look at history, just look at history. Every time the unemployment rate is at very extreme levels, hint, hint, it is at very extreme low levels and has been doing very well, we see a spike up. And then when it spikes up by, I think the number is something like 0.4%, 0.5%, you get followed by a massive spike up, followed by a recession. And we're starting to see signs of that. And when that happens, right, guess what? They will cut. And they just told you here. They just told you here. When the employment situation gets worse off, they'll be cutting because that's going to seep into the inflation data. In fact, we won't be talking about inflation. We'll be talking about deflation because of how bad this recession is going to get. Okay. The other thing is, we'll talk about here, there was no proposal to cut rates today. There's a wide disparity about when to cut, okay? So they want to cut, but there's a wide disparity. Some people say, yeah, let's cut early. Some are like, no, wait later, right? We need the tightening to really seep into the markets. So huge disparity. They're not agreeing on the at the FOMC. The jobs market is rebalancing. It probably takes a couple of years for wages to normalize. Okay, that's not a good thing, right? Job market is rebalancing. It will take a couple of years for wages to normalize. If wages are not going to normalize anytime soon, that means inflation is not going to normalize anytime soon. It will, however, if shit hits the fan and the economy gets worse off and that unemployment rate skyrockets, then yes, it will normalize way well. It will it will really seep into the inflation numbers, and you'll see that when it comes, if it comes. We're not looking for inflation to anchor below 2%, is what he's saying, right? Because by then it will already happen. And by then, it will already happen because the job market's getting worse off and shit's hitting the fan. Again, like I was saying, we want to finish the job on inflation while keeping labor market strong. Overall, it's a pretty good picture on the economy. Why are you lying? I don't think it's likely we will have enough confidence to cut in March. I don't think that's the base case. There you go. That was the line that caused the stock market to just completely tank today. And that was the line that basically wiped out the probabilities of a rate cut in March. We still got more data, but we will have to watch data by data. We won't keep it a secret when we have confidence on inflation, obviously, because by then things will be worse off. It won't be a secret. Trust me, it won't be a secret. I, I'm not so worried that growth is too strong and inflation could come back. Of course, you're not too worried because you don't think the banking system is resilient and sound. So yeah, growth is not going to be strong down the road, and inflation is not going to come down. It's going to be suffocated because you're going to get pretty bad numbers, growth numbers coming out, recession, and so on. And a very good example of this, just look at China. Okay, just look at China. They have deflation that's happening there in their country. The real estate market is tanking. Their stock market's tanking. They come out with a stimulus package to save their stock market. It's not going to work. It hasn't been helping, and it's been on a downward trend. And last but not least, continued declines in inflation are what we're looking at. Okay, so in order to determine what they're going to do in terms of the rate cuts, it's very simple. If that unemployment rate skyrockets, they're going to do something about it. I just showed you right here in that line. They said if the unemployment rate, something happens there, they'll be cutting sooner. They'll start cutting. Guess what? By then it'll be too late. Okay, that number is lagging, and all these economic numbers are lagging. And by the time it really shows its true colors, it'll be too late. They're already late. Okay. So number one, employment rate numbers. Number two, the data. We're going to have to look at every data point month by month, and I'll cover it on this channel here. How things are shaping up, what's going on in terms of the layoffs, the growth, the earnings, all of those things. How is that playing out in terms of the economic health of the economy? So if you're seeing the jobs data get worse, right? We're going to get the jobs data this week. We're going to get it Friday. We're going to get it next month, the month after, and so on. If those numbers start to really deteriorate, then guess what? You can expect the market's going to quickly price in some sort of rate cut coming soon. Okay. What else can I tell you? So yeah, let me just quickly show you how the market's played out. Here you go, right? You got all the equity indices, Dow Jones collapsing. You had Russell 2000, Nasdaq, and S&P 500. This was for today. You had a little bit of a squeeze at 2:30, which shook a lot of traders out. But then it completely collapsed on that comment that March rate cut is out. Now look at this here. This is really even more interesting for me, the bond market, right? We had a little bit of a shakeout in the bond market on the hawkishness, then a rally. Same thing here. Again, March rate cut is out of the picture. Guess what happened to the 5-year bond, to the 2-year bond, all the bonds, 10-year, 30-year, it sold off. But now look at this. bonds are near highs on the day, right? It completely rallied, especially the long end, because it's driven by inflation. And the short end, which is being driven by those rate cuts, since it's not coming anytime soon, that's why you're not seeing this move up in the 2 year, the 5 year as aggressively. But if you look at it as a whole, especially the long end, all the bonds are near highs. They completely shook off the hawkishness from the Fed. And what's this basically telling you is two things. The bond market is worried about an economic slowdown. The bond market is worried about a recession. And the bond market is calling Powell's bluff that no, sir, you are going to cut soon because you are going to break some shit. And shit's going to hit the fan. And that's how it's going to play out. Okay, so here you go. Everything that I've been going through on this channel, every video I've been posting, talking about how everybody who's saying rate cuts is a good thing, right? Especially maybe you might have realtors, those TikTok people on TikTok, TikTok traders, TikTok realtors, TikTok agents, right? All coming out telling you that, oh, rate cuts coming in. Guess what? Everyone's going to chase and buy real estate. Everyone's going to chase and buy stocks, maybe temporarily. But I just showed you through those words from Powell in the press conference, in the statement, that he's not going to do anything until the employment gets worse off, until more than 6 months of data that inflation looks good. And let me tell you something. Why would inflation get better if the economy's fine? So if the economy's not fine, then inflation will get better, reach to their 2% target, which means the unemployment rate will get worse off, which means jobs will get worse off, which means the rate cuts will come in. And then if people are losing jobs left and right, who the hell is going to go out chasing real estate? The only ones who are prepared, who have cash on the side, corporations, hedge funds, Wall Street, investors, those are the ones, okay? Not the frenzy you saw in 2021, okay? Everyone likes to use that 2021 as an example. It's very annoying. It's very annoying, the crap that's out there on the internet, the crap that, these agents come out and try to sell you that we're going to see 2021 all over again, like this year. This year 2021's coming. Next year 2021's coming, right? And you know what? Let me give them a probability, a 5% probability that sure, maybe they're right. There's a chance that I can be wrong, that yeah, this might be a soft landing, but I doubt it, right? This is playing out exactly like in previous recessions, previous histories, how things play out. And if I'm going to, make a bet and choose a side, it's that this doesn't end out as a soft landing scenario. This ends up being a hard landing scenario, and those rate cuts that everybody loves talking about, it's not going to end up in a good situation, in my humble opinion. But this is not financial advice. I'm not a registered financial advisor. I'm just a guy looking at macro, looking at markets, giving my 2 cents. Do as you wish. Take this however you want. But again, don't trade off it. Don't invest off it. Make your own financial decisions. Consult with a registered investment advisor before making any decision. And hey, this is what I think with looking at everything, analyzing Powell, what he's saying, those words, those keywords, those press conferences, the statements, the bond market reaction, the stock market reaction, and putting it all together. So anyways, if you like content like this, hit the subscribe button, hit the like button, the bell icon to be notified on the next video, and leave a comment below. Let me know what you guys think. What do you think about the press conference? What do you think is going to happen in your own country if you're not living in the US? What do you think is going to happen in terms of rates, monetary policy, economy, other countries you might be following, markets, etc.? Leave a comment below, and I'll see you guys around. Cheers. Bye.